Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. And first of all, I just want to take this time and thank everyone for attending the call today. I know that January has been an absolutely brutal month. Whether you're invested in stocks across the board or more focused on growth, such as strategies such as ourselves that focus on growth investing, it's been a brutal month. So what we want to do today is really focus on why stocks have been so weak, why growth in particular has been getting hit the hardest, and what is the path forward and the expected time to recovery. Why are we going through these things? Well, obviously, people are scared whenever we get stock market corrections. But number two, and we've only done this two other times, March of 2020 and August of 2021, we are putting an all clear signal. We think we are within a few days of a durable market bottom, and in particular, a growth stock bottom. We think this is one of the most attractive times that we've ever seen as a strategy to invest into our strategy. Now, we are somewhat biased because it's our strategy. We recognize that. When we look at the numbers, we look at how oversold growth stocks are and the stock market as a whole is, and we look at how bearish investors are relative to bullish investors. We haven't seen these numbers since March of 2020 and since December of 2018. Both of those proved to be generational investment moments into our strategy and to growth stocks in general. So we're going to go through all of that today. Now, I'm going to go ahead and share my screen, and we can see that chart here on the right. We don't typically start the first slide with a chart, but when we look at the level of bearish investors relative to bullish investors represented by red lines, this hasn't been this extreme since March of 2020. We think that we're at that durable market low right now. Now, is that a guarantee? Of course not, as we said before. But when we look at the numbers, that gives us a high level of confidence relative to other expected outcomes over the next few months. Expected time to recovery, when we look at March of 2020, December of 2018, when things get this oversold, we think that expected time to recovery on these extreme drawdowns is in and around that 2 to 4 month period. We would say 2 to 4 months is where we'll see a great deal of that recovery. Could it be 100% of the recovery? We can't tell you that for sure, but we think that this is going to be a very aggressive rebound that we see playing out here over the next week to 2 weeks and beyond. The other thing that we're going to talk about this week is why is the stock market selling off, and what does a durable stock market bottom look like? Very short term here, ladies and gentlemen, Monday was a brutal open. We know that that was where the cascade of selling overwhelmed the market. We put in those lows around 9:30 a.m. Pacific, 12:30 Eastern. And what we've noticed since then, and this is through Monday, which was a positive reversal day, Tuesday was a negative reversal day, Wednesday was a negative reversal day, is that one good reversal day felt great. The other 2 days haven't felt so great. Is that we're putting in successive higher lows on the price action. This is the triple Qs that represent the NASDAQ. And that's what we're looking for. We're looking for those higher lows. We look at our strategy, we see the same thing. Higher lows, successive higher lows throughout the days. This opens the door to higher prices. This is how bottoms start to form. So when we're thinking of stock market corrections, ladies and gentlemen, we really do have three options at our disposal. One is we can use a stop loss strategy, which a lot of investors and advisors have asked us about in the past. We can sell our investments to play defense, play cash, so we have that cash for a better day. That's one option. Sounds pretty reasonable. Number two is we hold the line and we act with patience, or we use moments of weakness to stack shares in valuable companies that we love. So why are we talking about this? Because we know that stock market corrections are the number one event that throw investors off their long-term investment path and what hurt long-term returns. In fact, the average investor, when we go back decades, has realized a return of about 2.6% across different asset classes, while the US stock market has realized annualized returns over 30 years of around 10.2%. What is causing that dislocation? Well, it can be broken down into three factors. Investors like to buy when others are buying. It's a part of our human nature, right? So when things are rising, it feels comfortable to buy. It's that inflationary impulse. Number two, As fear rises and account values start to fall, we don't like to see that. I haven't liked to see my account values over the last month. Investors panic and they sell. And then number three is they hold cash. They have that saying where they say, hey, I'm going to hold cash, wait things to settle down, and then I'll get back in. So we want to be very, very careful about using cash as defense, because most of the best days of the market are clustered around market bottoms. Think of it as an elastic. The harder you stretch that elastic in terms of the selling violence, the harder it's going to rebound on the way back up. So why is the stock market selling off, ladies and gentlemen? More jobs, fewer workers. That is leading to high employment, but also some wage inflation. And higher inflation in terms of the market makes investors worry that we're going to have higher interest rate policy. So this entire re-rating of stocks that we've had is a result of this assumption that we've gone from a couple rate hikes in 2022 to 4 to 5 rate hikes in 2022. Now, here's the thing. That's priced in now, okay? So this level going forward, we're assuming 4 to 5 rate hikes. That's priced into stocks right at this moment. But what happens if that's as bad as it gets in terms of rate hikes? What happens if it doesn't quite reach 4 to 5 rate hikes? In other words, those commonly held assumptions are false. Well, let's take a look at that. So first of all, growth is slowing, right? That's the first thing. Negative surprises are starting to outnumber positive surprises in terms of the economic data. In other words, those growth expectations are starting to come down across the US economy. Not recession, just a slowing down. Number two, 5-year forward inflation expectations are also rolling over. Inflation expectations peaked in November, right as the Fed made a pivot. So here's the question. Inflation is slowing, growth is slowing. Will the Federal Reserve increase 4 to 5 times, or will they increase less? That's the interesting question at hand, because we've already priced in 4 to 5 times. So if we're at 4 to 5 times, that's still fine. That's still great. But what if it's even less? So from a game theory standpoint, what do we buy or sell if that's the case? So here are our general rules, ladies and gentlemen. When everyone is fearful and stocks are massively oversold, that's when we put out the all clear signal. That's when we have a high conviction buy zone, in particular growth stocks versus value as it relates to that level of oversold condition. The opposite is true when most stocks are overbought and no one is fearful. Where are we today? We see the level of bearishness as it relates to QT and the growth scare that's currently taking place right now is at the same level as the COVID pandemic, the December 18 Powell rate hike mistake, the oil collapse back in 2016, and of course the Euro debt crisis and the US debt downgrade. All those events proved to be massive buying opportunities. When everyone is bearish, that's when we want to be bullish. And why is that? Well, the forward returns prove that when everyone is bearish, and we can see in the bolded line here, the 2-year annualized rate of return is about 18.5% versus when everyone is bullish, it's negative 0.3%. We stretch it out to 5 years, it's 53.5 versus 17.1%. And of course, we see it in the sentiment. The number of advancing versus declining stocks is deeply negative and back to March of 2020 levels. In other words, this line here, that's the number of declining stocks relative to advancing stocks. When we reach these levels, that's where stocks are heavily oversold and often revert back to the mean. That's where we want to be buyers, opportunistic buyers. So the question is, do you want to buy or sell in moments like that? And if the answer is buying, well, what do we buy? Right now, the NASDAQ, the percentage of NASDAQ members that are trading above their 200-day moving average, that year-over-year change, hasn't been this negative since 2003, 2004. Each time we get to these successive extreme oversold levels, that's when we want to buy the NASDAQ. And we look on the flip side, everyone has now piled into cyclicals. In other words, energy, banks, and materials. That's where the downside surprise is most at risk and why we sold those energy stocks, albeit too early by 2 weeks. But when we look forward now, that's where we see the downside risk. So the bottom line message, ladies and gentlemen, is yes, with these stock market corrections, especially today, March of 2020, December of 2018, they feel like the world's ending. But that is when we want to lean into the market, be disciplined, and either hold the stocks we currently own if we like them, when we like the companies that we own, or buy. It's increasingly unlikely when we look at the data, slowing growth, slowing inflation, that the Fed will ultimately raise rates 4 to 5 times. We already see inflation starting to peak out. Number two, stocks are increasingly oversold and bearish sentiment is back to 2020 levels. So what does that mean? When bearish sentiment is this extreme, that's when we want to buy, not when we want to sell. Listen, the last 3 weeks have been terrible. It's whether you're a stock market as a whole or growth focused investors, it's been painful. But now is the time we want to be disciplined. Now is the time we go back to that March of 2020 playbook, that December 2018 playbook, and we want to be opportunistic, not fearful. If you own good companies, at the end of the day, those stock prices will come back. So if anyone has any questions, please reach out to your advisor. Reach out to us at any time. We know it's a time of uncertainty, but reach out to us. We're here to help, and have an absolutely fantastic weekend.